Investing industry shenanigans. This has got to stop, man. I can't stand it. I wonder if John Bogle, he's just gonna be rolling in his grave, saying everything I've taught you people, and yet you still fall for the investment industry shenanigans all the time. So frustrating. So I'm reading this article. This is on page 17. Okay, I'm gonna share with you. An inconvenient fact: private equity returns in the billionaire factory by this guy, University of Oxford said business school. I came across this by Matt Stoller's big blog on Substack. I'm a big fan of Matt Stoller. Big lib, this guy. A lot of his commenters are big libs, but I think Matt's an open-minded lib. It's not doesn't fall, I don't think, for the false dichotomy of red versus blue anymore. But a lot of his commentators do. They're very, very very left wing. Democrats are good. Everybody else is bad. It's actually too bad. And we get the same on the right. I mean, hell, I probably do that myself. But anyway, so he had a bunch of articles in here that was very interesting. Some of this I took issue with, but I posted comments there. But anyway, I want to go down to Yale. So we're going to go to page 17 here. And I want to we'll come back around to this because I freaking hate this stuff, man. I hate because it's fake news and no one cares. The regulators don't do anything. No one does anything because they're all in on it, man. Anyways, there we go. So let me put it this way. When I was back in the aughts, a guy named David Swensen over at Yale Endowment, everyone kissed David Swenson's butt. We got to be more like Yale because he didn't really believe in U.S. stocks and he did believe in other things like forced private equity, all kinds of real estate, whatever. And literally, he had this diversified portfolio that became known as a Yale model. All right, everyone wanted to be like David Swensen and Yale, and it was such a it's so doggone fake. And none of these other universities could match it. And David Swensen had a couple good years, and I guess he just died. R.I.P. I didn't know that. It's sad. 67 years old, he died from cancer. But it was so overblown. And even back then, anyone with just a sense could see that. And yet everyone's like, we got to be like David Swensen, the Yale model. It was freaking so fake. And I'm not saying what he was doing. I'm not saying David Swensen was deliberately doing it wrong or anything. But you could just see, it's like, that doesn't make any sense. How is this guy so far and away above everybody else? It doesn't make sense. Anyway, so an often heard rebuttal about PE, private equity, is that the Yale Endowment proves that investors can earn outstanding returns on PE. The story has taken almost mythical dimension, which has been addressed in another article my man did in 2013. There it is shown that Yale had presented as a performance figure every year, which had led the common belief about Yale's performance had never changed over the years. Huh? Yale had presented its performance figure every year, and it had never changed. My man here who wrote this book speculated the reason was the use of internal rate of return to measure performance. As noted earlier, IRR is not a rate of return. Yale's published track record until the publication of the article is reproduced in Table 7. This is their published track record. Annual return in private equity since inception. 34th, look at that. Look at that, 30, 30, 30, 29, look at that, 30, 30, annualized return, 30%. Annualized return over 10 years. And right here I'm going to 2008, which is odd because in 2008 and 2009, I'm going to show you something, they got crunched. Oops, where did I find that? Right here. We were down, I can show you right here, that's right here, I think it's where I clicked on. Let me pause it so we can, right here. Yale's endowment shed 29% from 22.6 billion to 16 billion in 2008. And yet they're still shown as if where is that here? Their annualized return as of 2010 went from 25 to, what the hell happened here? Look at that. You kidding me? So in 2008, they're down basically 30%. And then, but it wasn't reflected until 2010. And yet their annualized return in private equity, that was still 30.3, 30.9, 30.6. And then over 10 years, that doesn't make any sense. That's freaking nuts. Anyway, so let's keep going here. Yale then admitted these returns were in fact internal rates of return, and perhaps coincidentally, after 2013, they changed their presentation of their performance. In 2014, they reported the past 20-year internal rate of return has said this since inception at 36.1. Then in 2015, they separated leveraged buyouts and venture capital as recommended by this guy in 2013. And as anticipated, given the suspicion that the performance figures or internal rate of returns, an implausibly high figure for VC venture capital was reported at 93% per annum. And a more human figure is reported at leveraged buyout at 16% per annum. See Table 8. I mean, it's just, look at this. Annualized rate of return in venture capital, 93% per year. Annualized rate of return in venture capital, 241% per year for the last 20 years. And here's the leveraged buyout. I mean, what the hell is this? To his credit, Yale now acknowledges that the figure they provided in the report for past performance does not reflect the returns they actually earned. Adding this footnote does not seem to have altered the myth, though. This is the phrasing of the relevant footnote in Yale's 2017 report. Yale's 106.3% venture capital return over the last 20 years is heavily influenced by large distributions during the internet boom. Since such a calculation assumes reinvestment of proceeds from the portfolio during the period at the same rate of return for the rest of the period. Did you hear that? Such a calculation assumes reinvestment of proceeds from the portfolio during the period at the same rate of return for the rest of the period. It is inappropriate to compound the 106.3% return over a 20-year time horizon. For reference, the 20-year time weighted return of Yale's venture capital is 25.5. Annuals. Yeah, right. Returns for other illiquid assets are not subject to large distortions. All right. Note that the time-weighted return is not a useful measure either in this case because the returns are very skewed. This period probably includes 1 or 2 years with a return of 100% or more. The more informative measure would be the MOM, multiplier of money, but despite being repeatedly asked, Yale has yet to communicate for this common measure. Interestingly, if Yale opts to report their past 20-year return in venture capital again next year, the mathematics of IRR is such that the return would drop from a 256 per annum to about 15% per annum average, which will look particularly odd. It'll be interesting to see whether they then revert to reporting since inception IRR, in which case the reported figure will be over 30%. To sum up, Section 7A, although rebuttals often evoke track records of the Yale Endowment and other large institutional investors, the right information to assess their performance is rarely made publicly available. This is freaking nuts. So anyway, I just want to kind of go, man, let me show you here. All right, private equity funds have returned about the same as public equity indices since at least 2006. All right. The big four PE, private equity firms, have also delivered estimates within a narrow range. These 3 large data sets show that multiple of money access across all PE, private equity funds, about based in a narrow range. All right. These net apply 11% per annum rate of return. So 1.5 MOM multiple of money implies an 11% per annum return, which matches relevant public indices. Yet the estimated total performance fee carry, what they call carry, collected by these PE funds is estimated $230 billion. Most of which goes to a relatively small number of individuals. If all vintage years are included to 2015, carry, again, total performance fee, is $370 billion, with a performance similar to that of small cap indices, but higher than that of large cap. The number of PE, private equity multimillionaires, rose from 3 to 2,000 billionaires to 22 in 2020. Rebuttals from the big four and the main industry lobby are provided and discussed. It's freaking crazy. In the paper, I show that at the end of 2019, since at least 2006, net of fees of private equity funds matched that of public equity markets. Despite this lack of clear outperformance, the fee structures are such that a few individuals share large performance-related bonus payments. It is widely believed that paying carry, performance investment returns, is good news for investors because it means that returns have been good. A first caveat is that carry works only one direction, i.e., if they don't perform, they don't pay you. They only get paid if they perform. Hence, an investor may end up paying carry to some managers, even if its overall private equity portfolio performed poorly, because it's just based on total return, not relative return, relative to an index like the S&P 500. Second, carry is paid as a fraction of absolute performance rather than relative performance. Hence, although the latest decade of funds that terminated their investment period returned about the same as public equity benchmarks, about 11%, their managers still receive billions of dollars in carry and alongside other fees. Most of this money went to a few individuals. Yeah, exactly. One second. Most of the large pension funds have earned about $1.5 net of fees per dollar invested in private equity funds. At least since 2006, it's about the same they could have gotten a good old-fashioned total stock index. The Big Four PE seems to have delivered about the same. The average PE fund delivered about the same as well. A large fund, which I have details on fees and expenses, generated 1.5 times capital invested, and the cost to investors was $1.4 billion of carry and 1.4 of other fees, management fees, expenses, portfolio company fees. The fund size was $10 billion. They got 28% of the fund in fees. The fund size was $10 billion, and they got 2.8 in fees. Crazy. How could this be in equilibrium? It'll be fun to see what the old Yale did. Yale earns 40% return in fiscal 2021. This is from Yale itself. Now, I don't know if these guys pay tax on their money. I don't think so. They need to. And I think Trump signed a bill where they're going to start paying a little bit of tax, but they need to be paying taxes, man, because this is freaking nuts. Yale Endowment reported a 40% investment return net of fees for the year ending June 30, 2021, earning $12.1 billion in investment gains. All right, so it was an extraordinary year, says this guy. The endowment, over the 10 years ending June 30, 2021, Yale's endowment returned 12.4% per annum, trailing broad market results for domestic stocks, which returned 14.8%. Yeah, and how much these guys getting paid, man? But it exceeded results for domestic bonds, which returned 3.4%. The average return for college university endowments was 9.1%, again, well below domestic stocks. During the 10-year period, Yale's endowment grew from $19.4 billion to $42 billion. Over the 20 years ending, Yale endowment returned 11.3% per annum, exceeding broad market results for domestic stocks, which returned 9.1%, and for bonds, which averaged 4.6%. And well, it did it now. Interesting, because we're going to look at the paper here. Let's take a look. Secondly, this is my man who wrote the article. It's easy to pick a public equity benchmark with low returns. The standard choice of the benchmark used to be the S&P 500. Now is the MSCI, Morgan Stanley Capital, I can't remember what CI stands for, World Index, which is the all-country index. Another common benchmark is the Russell 2000. I show that these latter two indices have much lower returns than others. In addition, I show the average private equity fund net returns both pre-2006 and post-2006 are with 1% per annum of the net returns of both the oldest passive mutual fund investing in small stocks, Dimensional Fund Advisors, and the oldest active fund investing in large and small stocks, T. Rowe Price. And anyway, both before and after 2006, PE funds, private equity, have performed in line with comparable publicly traded stocks. Just the whole thing. So we're looking at this right here, like, what's the domestic stocks? What is that? Is that the S&P 500? I don't know. They're just saying domestic stocks. Who knows what they're saying? I mean, is it the total stock index? I don't know. Yeah, it's crazy, man. All right, let's just look at one other thing here. Yale's endowment couldn't beat the S&P 500, but here's how it did. Yale's endowment, and this is at the end of 2020, it looks like, at the end of June 30th, 2020, posted 6.8% return in the year ending June 30th. A mediocre, and I'm not here to pick on Yale, just the whole thing is insane. Let's see. College endowments are now reporting investment returns for the fiscal year ending in June. Harvard, whose endowment, Yale rivals Harvard endowment struggled in recent years, hasn't reported results yet. Yale's showing reflects the continued challenges faced by his longtime endowment chief, David Swensen, who pioneered the use of alternative investments. Yep, the strategy worked brilliantly in the 90s and 2000s, but it's not done as well. In fact, the 10-year annual performance would have matched a 70-30 mix of U.S. stocks and bonds. Interesting. Yale's long disdain for U.S. stocks, despite their impressive performance, and Yale's endowment has a weighting of just 2.25% in domestic equities. So how are we if they're how are you using a domestic equity benchmark if you the whole thing is insane, man. I just what is that? So we're using a domestic equity benchmark, but we only have 2.25% domestic equities. Or I get it, you could say, yeah, we're using a domestic equity benchmark because we could have easily just bought an S&P 500. Yale's largest target asset allocations are to absolute return, mostly hedge funds at 23.5%. Yeah, exactly. And who do you think's making bank off of Yale's endowment? And all these endowments. You know who it is? It ain't you and me. Don't look down. It ain't you or me. Yale's absolute return investments are designed to produce good risk-adjusted returns regardless of the direction of financial markets. Again, that did not happen in 2000. It was this right here, 2009. Yale's endowment was down 30%. So what's that about? Hmm. Crazy, man. Anyway, the point being is the whole thing is just full of shenanigans. And don't do the shenanigans. That's why I buy good old fashioned index funds or well managed, actively managed funds like Wellington. And don't. There's no better mousetrap. I tell you, all the people. I just remember 2005 and six. David Swenson. Whoa, yeah, he's the best guy since sliced bread. Yeah. Look, man, you just buy and you hold and you reinvest. That's it. Buy, hold, reinvest. All right, love your thoughts, and I'll try to link the article here. See ya.